Welcome to the Impact Monthly Webcast series on growing a business. I'm Dr. Cindy Mencius, the Impact Director of Contractor Training and Development. The goal of the webcast series on growing a business is to provide our contractors with information, tools, and resources that they can use to grow and improve their business. We're conducting one webcast every month during 2015. And each webcast covers a business topic relevant to the operations of a contractor who works in the ironworking industry. We've selected subject matter experts to be our instructors, and they will identify additional resources that you can use to learn more about their topic. As part of our new initiative to thank viewers who join our popular webcast series live each month, Impact is selecting episode viewers at random to receive a special thank you gift for watching. Each monthly winner is contacted by their email address to let them know about their gift, and we'll announce the winner the following month. Last month's winner was Michael Durant from BWI Steel and Precast Erectors in Boston. Congratulations, Michael, and thank you for watching. Today's webcast subject is bonding capacity, and our instructor is Kathleen Baldwin, a certified public accountant for Warren Averett in Pensacola, Florida. Kathleen joined the Warren Averett team in 1999 and is a member of the firm's audit division. She has more than 14 years of experience in public accounting, and she's a leader within the firm's construction practice group, which focuses on the delivery of accounting, auditing, tax, and consulting services to construction industry clients. Kathleen, welcome back. Thank you for addressing our Impact audience this month.
Well, thank you for having me. All right, everyone, we have an exciting program today on bonding capacity. There is a lot of information for us to cover, and we are just going to hit the highlights of the various components of establishing a bonding program and maximizing your bonding capacity. So let's begin with our today's topics. What is bonding capacity, and how can it be a benefit or a detriment to getting work? We're going to cover what characteristics do sureties look for in contractors when establishing a bonding program. What factors should you consider when trying to maximize your bonding capacity? And then how can you plan your balance sheet to improve or increase your bonding capacity? So let's start with a little bit of background information. Why are jobs bonded? A bonding program and the need for surety contract bonds is really an owner's risk management tool. We all know that no matter how well you plan a job or how well a project is managed, there will always be an element of risk. Surety bonds provide a level of assurance that a project will be completed even in the face of unforeseen circumstances. So what is the role of the surety? The surety provides assurance to the project owner that the contractor is capable and qualified to do the job. If a contractor defaults, the surety provider arranges for the completion of the project. The surety provider performs an exhaustive review of the contractor when establishing a bonding program for contractors. So what are some basic points and some terminology related to a bonding program? So a surety bond. The bond itself is an agreement between three parties: the surety company, the contractor, and the project owner. A surety bond is not insurance. It is more like an extension of credit. That is a huge misunderstanding in the industry, and that many folks believe that a bond is an insurance because you go to an insurance agent to purchase, to establish a bonding program. With a surety bond is when if you have a claim on that bond, a performance bond, you're unable to perform complete the project for whatever reason. Maybe it's because the project, your organization had to go bankrupt, or maybe the project had something that was above your skill set and your resources. But no matter what, regardless, if you're unable to complete that project, then the surety is responsible to go find another contractor to complete your project. Whatever cost that surety incurs on behalf of finding someone else to finish this job on your behalf, they are then going to come back to you as the contractor that they originally issued the bond to, and they're going to try to recover those losses. And they're going to try to recover those by either making a claim against the assets of the company or against you personally. There are typically three types of contract surety bonds: bid bonds, performance bonds, and labor and material bonds. So what is bonding capacity? What does that mean? That is the maximum total contract value a bonding company will extend to a contractor in performance bonds. It is the sum of all of your contracts being bonded. Bond premium. You may ask, well, how do they come up? How do they calculate what the bond premium is? It is typically between 0.5% and 2% of the contract amount. It is intended to cover the underwriting process itself. It is not meant to establish a reserve for the sureties to pay out losses. And as I mentioned before, losses are recovered by claims on your assets. So if you're looking at a $1 million contract to be bonded with a 2% premium, then you're looking at $20,000 in fees, a bond premium for that bond. So what are the qualities necessary for bonding? And you will hear the reference to the 3 C's whenever you're speaking with any surety or any other contractors that are familiar with the bonding program. The 3 C's of the surety industry are well known. It's character, capacity, and capital. So for character, what is the surety looking at? The surety is going to look at you personally and your organization's reputation. They're going to look at your job performance history, your relationship and your history with suppliers and subcontractor payments. Do you pay your subs timely, or do you pay them 90 days out or 60 days out? They want to make sure that your subs are being paid timely. Remember, especially if they're going to be issue a labor and materials bond. They're going to also look at your banking relationships. Your capacity. They're going to look at your experience. They're going to look at historically, how many projects do you have open at any one point in time? What is the total dollar value of those projects that you have the experience to be able to handle? And they want to make sure that you're not looking to get bonded on a job that is going to be something that is outside your typical experience history. They're going to look at your track record. Do you complete jobs timely? Do you complete jobs close to where, what you estimated your gross profit to be when you started the job as to where you finished the job? They're going to look at your equipment. Do you have the equipment necessary? Either your company owns the equipment, or you have the ability to go out and lease the equipment to satisfy the performance obligations of that project. And they're going to look at your personnel. They want to look at your key project managers, your key job supervisors, your field supervisors and foremen. They want to know that you have the personnel in-house today that has the experience and qualifications to be able to complete the project. And they're going to look at your capital situation. They want to know your financial situation. They want to know, what are your working capital numbers? Do you have either the cash on hand or access to cash to be able to complete the project? Your bill paying ability to complete the project. They want to make sure that you have the ability to be able to pay your subs and pay them timely, to pay your vendors, and to keep operating your organization. The concern is that maybe this project is so large, it's going to be such a drain on your cash resources, you're not going to be able to fund the project. And then they're going to look at various ratios and tests. So what is the surety looking at when establishing a bonding program? And there are 4 major categories that they're going to do extensive reviews on. That's going to be financial information, company information, banking and insurance information, and then they're going to look at the job itself that you're wanting to get bonded on. Is that good?
Why don't you just go through that slide?
Okay. So for financial information, what is the surety looking at when establishing your bonding program from the financial information standpoint? They're going to look at, are you currently receiving annual financial statements from a qualified CPA? And qualified CPA means they want you to make sure you're using a CPA that understands the construction industry. As you know, there are many nuances of the construction industry, and construction accounting is a little different than the normal for-profit accounting. They want to make sure that your CPA understands construction accounting. They want to know what types of financial information, financial statements you are receiving. Are you getting compiled financial statements, reviewed financial statements, or are you having a full audit performed? And they want to know the frequency. Are you having the CPA provide these services to you on an annual basis, or are you getting reviewed financial statements twice a year? Or are you just doing it every couple years whenever your bank is telling you, oh, I need a set of reviewed financial statements? So they want to know the frequency that you're receiving these annual financial statements. They're going to want to see your tax returns the last few years. They're going to also want to have a schedule of your equipment. And again, that is to look at, do you have the equipment on hand to perform the contract, or are you going to need to go out and lease the equipment? And then they're going to want to see the personal financial statements of the owners. And they're going to want those personal financial statements reconciled to the company statements. And what I mean when I say that is that if the company has loaned you personally $25,000, and so the company has a receivable on its books, an asset of $25,000 due from shareholder, they want to make sure your personal financial statements have that liability showing the $25,000 that you owe back to the company. And what that lets them know, if those financial statements reconcile at the time of submission to the surety, that lets them know that, hey, I have good accounting controls in place and I'm making sure all of my financial information is accurately stated. The company information. Clearly they're going to want your org chart. They're going to know who are your employees and what are their responsibilities. We want to make sure that your project managers, your job foremen are able to actually focus on completing the job. Not that they have, human resources responsibilities back at the office or, any accounting responsibilities, IT. Let's make sure that they're able to focus on the projects. Resumes of principals and key employees. They're going to want a description of your cost accounting system. That's also known as your accounting software, or you may hear it referred to as your general ledger. They want to make sure that you have an accounting system in place that is able to properly track job costs, job billings, assign them to specific jobs, so that way at any point in time, you're able to generate reports out of your system to let you know where you at on the job. What is your profit and loss to date? Do you have the work in process schedule, also known as the WIP schedule? Are you maintaining that? What are your management policies and controls for monitoring job performance? Something they want to know is, hey, do I bring in all the project managers once a month? And so for all jobs over a certain limit, say all jobs over $100,000, once a month we review those jobs, the estimated cost to complete, evaluate where we're at so there's no surprises late in the game. Or do you do this weekly? So depending on the size of your organization, the size of your jobs, they want to know how often you're having these meetings or what you're doing to stay in touch to monitor a job's performance. Your business plan. They want to know, what is your company's specialty? Do you specialize in constructing hospitals or being a sub for hospitals? Maybe it's going to be school systems. Maybe it's strictly governmental business. But what are your specialties? What is your market, your geographic region? And then, do you have a business continuation plan? And this is something that when contractors first begin to establish a bonding program, most of them haven't thought of a continuation plan. They're like, we're just in survival mode trying to get through, this year, be profitable, especially in this economy that we've had for many years. But through your surety relationship, you will begin to understand the importance of having a business continuation plan. What if something were to happen to you or to happen to your key project manager tomorrow? How is the company going to survive? What do you have in place to make sure someone else can come in, take over the jobs that are in progress, see them to completion, and continue the success of the organization? And then they're going to ask for significant references, and they're going to call those references. They're going to want to check with, past project owners on jobs, your suppliers, your subs, your bankers, your CPA. They're going to want to have conversations with each of those to learn a little bit about you and your organization. Your banking and insurance information. They're going to want a bank letter that shows the history of your relationship and your balances. Have you maxed out your line of credit for the last 3 years? Does it stay at max? Or is it more cyclical? Is it more seasonal to where you tend to maybe draw on the line of credit towards the early part of the year, and then by the end of the year, just the timing, because of the nature of work you perform, you're able to pay down that line of credit, and they'll see that history. They want evidence of a line of credit. They want to make sure that you have cash available to you should you need it to complete the project. So if you have a $500,000 line of credit, they want to make sure you've only drawn about 300 of it. They don't want to see you staying at $495,000 all the time. You paid off 30 days, and then 45 days later you need to draw it all back down again. And then you paid off, and then 2 weeks after that you need to draw it down again. They like to see that you have some availability on your line of credit. And then they're going to ask for your certificate of liability insurance. When it comes to the jobs, they're going to want the contract, the bid results. And the reason they want the bid results is they want to look and see, if you were the lowest bidder on the job, if you were the lowest bidder by 10%, and say there were 3 other bidders on this project, or more like 7, in this time, but they want to know why do you think you can complete this job 10% lower than everybody else that submitted a bid? And so they're looking to make sure that you didn't overlook something, that you didn't forget something. And it might be that you have just figured out a particular process to complete this project, and it is more efficient than any of your competitors. They're going to want to see the actual subcontracts. They're going to want to review those contracts, look at that language in those contracts. And then again, they're going to want to look at your job history. They're going to want to look at, the history of if you've performed any other contract similar to this one. Again, if this particular project is going to be a sub on a major hospital renovation, have you worked on hospital renovations in the past, or is primarily your niche in apartment buildings? And they want to make sure, okay, why do you feel like you have the skill sets and the ability to be able to perform this contract for the hospital? So how is bonding capacity determined? There's many factors that go into it. There is not just a checklist that you can say, yes, 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 boom, I should have the bonding capacity of whatever I desire because I meet all of these criteria. It is very, very subjective, and it is very important that you develop a relationship with your surety, okay? So some of the factors that are considered is, what is your history of performing good quality and profitable work? Strong, timely, and accurate financial reporting and controls. If the surety were to contact you and say, hey, can you send me, we're in the month of October right now, can you send me your June 30 internal financial statements? And your response is, oh, I'm sorry, we don't have June closed out yet, but I can give you May. Okay, the surety is going to question, well, how are you managing your business? How are you looking at job performance and where you're at on your jobs if your financials are 3-4 months behind? So they're going to want to make sure that you have, strong, timely, and accurate financial reporting and controls. And another thing on the accurate financial reporting is, typically the bonding guys are always going to want 12/31 financial statements if that's your year end. And you're into May and you don't have your financials yet from your CPA. The surety is going to question and say, first of all, if you're using a CPA that is familiar with the construction industry, that CPA is going to understand the importance to get your financial statements in the February-March timeframe, knowing that you need this information for your bonding program. So if your CPA is familiar in the construction industry and it is May and you don't have financial statements yet, then the surety is going to question, is there something going on at the contractors? Are the internal records very messy and the CPA is needing to perform a lot of cleanup? Or is the contractor not able to get the information to the CPA timely, to get these financials completed timely? And you see, now the surety is going to have less confidence in those internal financial statements that you're sending all throughout the year, okay? And you don't want that. So you want to make sure that you have strong and good controls over your financial reporting. They want to see your bonding capacity. Now, remember, that's what we're talking about, is your total bonding program. Is, what impacts it is, have you been able to remain profitable over a number of years? The surety industry understands that you're going to have loss years. It's going to happen. It's just the nature of the industry. But are you continuing to lose money year after year after year? And if so, the surety is going to question, how long is this contractor going to be able to sustain this level of losses? So they may, lower your bonding capacity if they see continued losses. And this is a very, very important one, and this is one that, many contractors struggle with, is your bonding capacity, one of the factors is going to be, are you maintaining an acceptable level of capital within the business? And what that means is, if you have a profitable year, say you have net income of $200,000, then in March, you pull out of the company $195,000. Now, that I'm not saying you pull it out to make your quarterly income tax payments, doing owner distributions for that. This is just to pull the money out so that you can go buy a new boat, buy new trucks, upgrade your personal residence, etc. The surety is going to look at that and say, why didn't you leave any of that money in the company? You, Mr. Contractor, are wanting me, the surety, to have confidence in your organization, basically commit to your organization by going out on a limb for you to establish this bonding program, but I don't see that you're committing to the company. You're pulling out every single dollar of profit the company makes, okay? So you need to leave some of that capital in the company. So you'll see my big disclaimer across the top here. It varies by surety. How is the bonding capacity determined? And on this slide, I'm talking about the general formula in determining your bonding capacity. The general rule is 10 times your working capital. Now, sometimes if you're reading some literature or if you're discussing with your surety, you may hear the net quick number. That's essentially your working capital. But remember from a previous webinar that we did, the working capital, by definition to sureties and bankers, is not the straight accounting definition. The straight accounting definition for working capital is current assets minus current liabilities, okay? But the surety industry is going to adjust. They're not going to give you 100% credit for all of those items you have recorded as a current asset. So you need to know what your surety is looking at, what do they include or exclude in the calculation. So as a reminder, working capital is current assets, which are essentially for sureties, cash plus your AR that is 90 days or less, plus your cost and estimated earnings in excess of billings, minus all current liabilities. So if you have working capital of $100,000, that's about $1 million bonding capacity. Now, you see in notes here, see next slide for key points on working capital calculation. I want to emphasize here that I don't want you to walk away here thinking 10 times working capital, that's going to be what my bonding capacity is. There's a lot of factors that go into it, but that does just kind of give you a general idea of what your potential bonding capacity is. So this is just the standard calculation of working capital. And I want to show this slide because in a few slides later, I'm going to show you how this working capital number is decreased for the sureties. So with straight GAAP accounting, the working capital calculation for this set of this balance sheet here is current assets minus total current liabilities, $230,000. Okay, so if you were to have the general rule 10 times working capital, that's a $2.3 million bonding program. So let's talk about some of the key points of that calculation for the surety. Again, the definition of working capital may and will vary by surety. They're going to look at things like your inventory, your agent of AR, prepaid expenses, etc. Single job limits are likely to be much lower than the 10 times factor. So if you're bonding, if your surety guy says, hi, we're going to give you a $2 million bonding capacity, then don't feel overly confident that you can go out and bid on a $1.5 million job. Oh, I'm going to be able to get that bonding. I've been approved for a $2 million capacity. Most likely, your single job limits are going to be closer to the $200,000 range, not the $2 million total bonding program. And then your working capital times factor. That factor is going to vary depending on your relationship with your surety and the 3 C's that we covered previously. Okay, so your factor maybe for you and your organization might be working capital times 5. I've seen that quite often as well. So what are some discounted items in the working capital calculation? Intangible assets, goodwill, licensed software. Most likely those numbers are going to be excluded from that working capital calculation. Inventory, usually 30 to 40% discounted. Doubtful receivables, and any receivables over 90 days. And the thought process is, and keep in mind here, what the surety is looking for on your working capital is they want to make sure that you have, quick asset to cash if needed for you to satisfy this job, okay? So your inventory, maybe your inventory is not something that can be quickly sold, or maybe some of it's aged, or there's only a select number of buyers for what you have in inventory. Your aged receivable. If something's over 90 days old, there's a chance that, a very good chance that you're not going to collect 100% of that aged receivable. Now, when we're talking about aged receivables, we are excluding retainage, okay? So your sureties are, very familiar with understanding the concept of retainage and knowing that that's not going to be collected until the end of the project. So these are just the true basic trade accounts receivable balances. Your prepaid expenses, again, those are typically going to be discounted by the surety. And the thought behind that is your prepaid expenses are typically going to be insurance. And so that just happens to be timing of when you pay your premium and when that insurance matures. And it's an operating cost that you're going to have to spend anyway. So that's not like that's an asset you could turn around and sell. And then significant underbillings. Underbillings, remember, are your cost in excess of earnings. So that is your asset. So if you have an asset on your books for $200,000 worth of revenue that you've earned but you haven't billed yet, then the surety may question, well, why haven't you billed this $200,000 yet? Is it really because it's not collectible? And so we have an error on your job schedule, your work in progress schedule. So they're going to discount significant underbillings, most likely. So here is that working capital calculation again I showed you a few moments ago, and you see our original calculation of $230,000. If you take off the red items, which are the prepaid, deferred tax assets, the things that are most likely not going to be quick cash coming in the door, now your working capital is down to $155,000, so a $1.5 million bonding capacity. Now you look at the blue items that are going to be evaluated and possibly discounted. Well, now you're at a negative $30,000 working capital. And so you may say, Kathleen, I don't understand. I've got a working capital of $230,000 and my surety is telling me he's not going to issue this performance bond. Well, I said, we're going to look at that balance sheet a little closer. We're going to see what you have tied up in the various assets and see what can be done to, get that working capital, the solid working capital that the surety folks like, get that number higher so that you can get a bonding program established. So what are some other financial analysis considerations that go into determining your total bonding capacity? They're going to look at your debt to equity ratio. That is your total liabilities divided by your equity. And notice that says total liabilities. So many people think the debt to equity ratio relates only to your notes payables and your line of credit. Your debt to equity ratio includes all your accounts payable, your subcontractors payable, accrued expenses, etc. So your debt to equity ratio should be less than 1. The lower the ratio, the better. And the reason that is a lower ratio means the company is using less leverage and they have a stronger equity position. The surety is going to look at how is your debt structured. Is all of your debt current, or do you have a portion of it long term? Are your debt leases, capital leases, or at notes payable? Some things to look at is consider selling equipment and leasing it if your equipment is not used regularly. So remember, owning that heavy equipment is not helping your working capital, it's hurting your working capital calculation because that equipment is not considered a current asset. But the debt associated with that equipment, what is due the next 12 months, is a current liability. So you see that having that equipment that you may only use once or twice a year, maybe a month at a time, versus if you were to go out and just lease that equipment for the project when you need it, then that might be a better way for you to position your balance sheet so that you have a more favorable working capital number. And then you want to minimize your overbillings. Overbillings are something that the sureties look at. It's okay to have a small amount of overbillings, maybe $25,000 per job. You're talking a job that's a couple million, several $100,000 in size. What they don't want to see is we don't want to see $200,000 in overbillings and $10,000 in cash on your balance sheet. Okay, what that tells the surety is that I am charging my customers ahead of when I'm performing the work, and I'm using that money to cash flow the organization itself in total. Okay, so you really want to look at your overbillings. Some other things that they look at in determining your bonding capacity is your profitability, the historical track record on your job, your estimated profits versus your actual profit, and that is like a gain fade analysis. And then they want to see that you're controlling your overhead cost. So how can you plan your balance sheet to improve your bonding capacity? Collect those aged receivables. If something is over 90 days, find out why it's over 90 days and see what you need to do to get that money in the door sooner. Make sure that there's not any customer disagreements, or maybe that there's not information that the project manager has that the accounting personnel hasn't received yet to get that money collected. Monitor your overbillings and your prepaids. This is usually a very easy thing that contractors can do. Depending on when your insurance premiums renew, your general liability, your auto, your building coverage, depending on when those policy periods cover, that is going to determine how much you have in prepaid at year end. Because as you know, you pay a significant deposit, and then you'll pay 9 monthly installments. In the last 2 months, you pay any premiums at all. Well, if your policy renews, say, October 1 of every year, by December 31st, you're going to have paid the large deposit, and you're probably going to have paid 2 monthly installments. So you're going to have a significant prepaid expense at year end. That prepaid asset is not benefiting you as an organization when it comes to establishing your bonding capacity. All right. So, what I would suggest you do is speak to your insurance company and say, hey, can we write a 15-month policy, or maybe a 3-month policy, or a 4-month policy, so that we can change my policy renewal time from either December 31st or really January 31st. And then that way your deposit is being paid in January of that year instead of the deposit being paid in December. Most insurance companies, in fact, I don't know that I've ever seen one that has denied, doing that. They can just write a stub period policy for you, and that way it will change your year end, and that's going to help you, have true working capital, numbers that are not going to be discounted by the surety. Another thing you can do is convert your line of credit to long term. If your line of credit renews in February, and you have a $500,000 line of credit, and we're doing the 1231 financial statements, then you're going to have a $500,000 current liability. So what's that going to do? That's going to automatically lower your working capital calculation by $500,000. Talk to the bank, see if they can give you a 14-month or a 15-month renewal on that line of credit. Let's let that line of credit renew in January of, say, 2017 instead of it renewing in January of 2016. And then now we can classify that line of credit as long-term, okay? And so boom, we've automatically improved your working capital number by $500,000 right there. Remember, if you have the 10% factor, 500,000, 10%, that's $5 million, okay? So leave equity in the company. That is going to be important. Now the question may be, how much equity should we leave in the organization? And that's going to vary. It's going to depend on everything else that's on your balance sheet. What do you have in liquid assets? What do you have in long-term debt? And then what size bonding program are you trying to establish? So obviously the larger bonding program your organization needs, then that's a higher amount of equity that your organization needs. So it's all relative, and it needs to be looked at on a case-by-case basis, but the important part is to leave equity in the company. And then another item here that we've covered is the PP&E. Do we need to own the asset, or are we better off just to lease the asset as needed until such point in time that our jobs, structure changes so that we need this piece of equipment, a significant portion of the year? Maybe at that time is when you would want to purchase the equipment versus leasing it. So what are some other things that you can do to maximize your bonding capacity? Make sure you have a sufficient amount of unused line of credit. Again, the surety wants to make sure that you either have the cash on hand or you have access to cash to be able to complete the performance of the jobs. Look at your organization, see what you have, a continuity plan. What you don't want to have is that the company is 100% solely dependent on, the general contractor himself, or maybe it's solely dependent on you have the best project manager in the region and he is the organization. So you want to have a continuity plan in place. I can't stress this next one enough, is you want to meet with your bonding agent and your surety on a regular basis. Now, a regular basis may mean quarterly, it may mean twice a year, but I say you need to meet with them face to face. And 9 times out of 10, the surety folks are going to be happy to come into your town and meet with you, not that you would need to travel anywhere. Discuss year-end distributions. And again, the point here is no surprises. Sureties understand that you are going to make quarterly distributions to pay your income taxes. What you want to do is make sure that they understand that. Make sure that they know when you're having these regular meetings with them that you're saying, hey, I'm going to make quarterly distributions every quarter to pay my income tax obligations. The surety gentlemen work enough with contractors, look at enough balance sheets and income statements. They can look at your financials. They're going to have your tax returns. They get a general idea of how much you should be distributing out of the company. What you don't want to do is have your estimated income tax distribution, say it's going to be $100,000, but then you do a distribution of $200 and $250. So now you're pulling an extra $150,000 of cash out of the company that the surety was not expecting to see. Limit loans to owners or affiliated groups. Your company is not a bank for you personally or for these related entities. The surety they don't want to see that. They're not comfortable with that. So I would encourage you to limit these due to, due from shareholders and due to, due from related parties for these other side businesses that you have going. Focus on your core business and your geographic region. Now again, we're talking about how to maximize your bonding capacity, okay? Not telling you how to run your business. You can go into whatever geographic you want to. But if you're wanting to look at what is everything I can do to take full advantage of, a bonding capacity potential, then the sureties want to know that you're working in a geographic region that you're comfortable with. Are you familiar with the labor in that area? They don't want to see you primarily working in the Southeast and all of a sudden taking a job over, in Washington State, and then it's like, okay, well, how do you know you're going to be able to perform this job in an efficient manner, finish the job on time? Are you familiar with the weather conditions that Washington State encounters as opposed to what you encounter in Georgia, Florida, South Carolina? So they want to see you focusing on your core business and your geographic region. Collect those old receivables, okay? If you don't collect those old receivables, that is money you're just throwing out the door. Improve your working capital, and again, leave your equity in the company. So your surety relationship is critical to your bonding program. And when I say relationship, I really mean that. Just like you should have a relationship with your CPA, you should have a strong relationship with your banker, you need to have a solid relationship with your surety. Know your surety company. What size companies do they typically underwrite? Are they historically working with very, small contractors, and here you are a large contractor? Maybe they're not as familiar with large contractors and what your, KPIs, your key performance indicators typically are. And vice versa. If they're accustomed to working with very large contractors and you're a small GC or a small sub, they may not be able to completely relate to your world as compared to the world of a large GC. Know what ratios and figures are considered important to the surety. Again, this way you can monthly or quarterly be watching those numbers to make sure your surety is going to be happy with your performance. Communicate. Regular meetings. No surprises late in the game. Bad jobs are expected. So if you have a job and it's a bonded job, or even if it's not a bonded job, because your surety is going to look at all of your jobs that you have outstanding, not just your bonded jobs. And you are estimating to have a gross profit of 12% on this job upon completion. And you're going through, 50% of the job, and you're still running at that 10 to 12% gross profit. Everything looks good. Then all of a sudden something happens and maybe there's delays, significant delays on the job for something that is your organization's fault. So now you're having to put a lot of extra labor on the project, paying a lot of overtime to get the project completed on time so that you can meet the due date clause of the contract. Well, now your gross profit may fall all the way down to 2%. Don't wait until the job finishes and you send your financial statements to the surety for him to see that that job that everyone was expecting to have a gross profit of 10 to 12% all the way through the job, all of a sudden the job finishes and it's at 2% gross profit. Okay, that's going to disturb the surety, and he's going to call you and say, what happened here? What's going on? Why didn't you let me know? Okay, so keep those lines of communication open with your surety. And integrity. You know, the surety does not want to see unjustified bonuses, questionable loans, you know, you going out, the company going out and buying a power boat or buying a condo on the beach. The surety wants complete confidence in the contractor's integrity. What are the benefits of a solid bonding program? A solid bonding program allows you to bid on public jobs and large private jobs. It lets owners and GCs know that you have been pre-screened. You know, we've talked briefly, we just touched the highlights of everything that the surety company is going to look at of you personally and your organization to establish a bonding program for you. So if you have an established bonding program, then others that are familiar with the industry, they know the importance of that. They know the significance of it. They say, you have had a thorough background check. You have, you know, your company has been looked at. You have the financial ability and the financial stability to complete any projects that I would like for you to work on for me. It demonstrates to outside parties that the surety has qualified your financial strength and ability to complete the job satisfactorily. And this is what is very important. It allows you to focus on the bid or going out and seeking additional work or the bid process itself versus spending time to obtain the bond. So if you have a solid bonding program, you have stayed in touch with your surety all throughout the year. He knows where your company is at currently. He knows where your company is going. And he even has a pretty good understanding of where your company has been. Then when you need to get a bid bond or a performance bond and you contact your surety, he's able to just let me get some current information. Send me the contract, you know, send me your most recent internal financial statements. You know, he may say, you know, have your CPA, you know, compile some June 30 financial statements. Just those few items, you send that to the surety and he can make his decision, maybe have a phone call with you. And you're able to really focus on putting together a good estimate and really, you know, working to get this new project. If you don't have a solid bonding program in place, you haven't stayed in touch with your surety, now this phone call to say, hey, I need a $2 million bond, it's going to be a lot more work and time and energy that you have to put into it currently just to try to get this bid bond now, and you're not able to focus on actually getting the work itself. So that is one of the huge benefits of keeping that continual contact with your surety all throughout the year, instead of just waiting until the day you need the bond or a week out when you need the bond. Because if it's a week before you need the bond, I can't tell you how many phone calls I get from contractors that say, Kathleen, can you compile some June 30 financial statements for me real quickly? You know, I'm trying to bid on a job on Monday and here it is Wednesday the week before. Okay, that's stressful on everyone. That's you, and it's you, the CPA, the surety, and it's not the best way to operate your business. So just in review, what did we, again, just briefly hit the highlights on? The surety topic is something that we could spend an entire day going over. The bonding capacity, what is it? How can it be a benefit or detriment to getting work? And the reason it can be a detriment is if your bonding capacity is too low, or if you've maxed it out and here's a job that you want to bid in and you don't have the capacity available to be able to bid on that job. What characteristics do sureties look for in contractors when establishing a bonding program? Remember the 3 C's. What factors should you consider when trying to maximize your bonding capacity? And then how do you plan your balance sheet to improve or increase your bonding capacity? So with that, I will turn it over to you for any questions we may have.
Very good. Kathleen, thank you very much for that very informative session on bonding. We did actually have a few questions come in from our viewers, and we have some time left to answer questions. So we had a question here that came in from Jim. Are you ready?
Okay.
Here's a question. So Jim is asking, are there any rules of thumb regarding bonding capacity as a function of total firm revenues?
I would say no, because it's going to vary by every construction organization. It's going to depend on what is the nature of your projects. Do you primarily work on public works projects, or are you private? And so if your company primarily works on governmental jobs, then most of your jobs are going to have to be bonded for you to be able to have those as clients. As opposed to someone who works on primarily private industry work, they may only have 10% of their revenues are bonded that year. So it's really going to depend on your organization and the size of your organization and the type of work that you pursue.
Okay. Okay, very good.
And it's not like you say 75%, if 75% of my work is bonded, oh, that's not a good thing. No, that's not the case. It is whatever percentage works for your company, then that's good.
Okay, good. Hopefully that answered Jim's question. We have a second viewer question. It says here, we are considering bidding on jobs that will require bonding, but we don't know where to start. Can you tell us where we should start?
All right. Good question. And I would say start with your insurance agent, the person that is providing maybe your workers' comp insurance, your general liability insurance, and ask them if their agency has a bonding, if they work with sureties to provide bondings. If they don't, then see maybe who in your area or talk to the other contractors in your area to say, who do you go to for your bonding? And there are many contractors who have a bonding agent that are hours away, not just located in that town. But go ahead and start having that conversation about getting a bonding program. And then I would talk with your CPA as well to say, if you were to call me and say, Kathleen, I'm getting ready I'd like to bid on jobs that require bonds. And I'm going to say, all right, I'm excited for you, but we need to do some cleanup on your financials before you're going to actually be able to get bonds. So let's spend about 6 months making some changes, getting some things in place to set you up to make the bonding process a much smoother process for you.
So someone should start about 6 months ahead or even more?
I would say, if you can anticipate within the next year, what are your organization goals in the next year, it's not too early to start, because you saw during my presentation the volume of information that the surety is going to want to get from you. You're still trying to run your business and accumulate all of this data and provide, explanations for things. And so I would say start the process a year in advance if possible, 6 months at a minimum. That way it's not a rush job and you're able to really start to build that relationship with that surety. Because he has to get comfortable with you, learn to trust you, and be confident that you know what you're doing as a contractor, but also that you know what you're doing as in regards to financial reporting.
So we have a lot of individuals who are new contractors. They should, if they're just getting started, they should maybe make this part of their startup process, start the bonding process?
If they think, it depends on what types of clients they're going to be pursuing, what is their niche. And if they think they're going to eventually, maybe within the next 12 to 18 months, be able to start working on those jobs, then if they're a sub, talk to the GC, because the general contractor may be able to pull that small sub onto their bonding program, and you can just latch onto that and not have to have your own program yet until you have become an established organization and have a history and you can get your own bonding program.
Okay, that's good.
But I would say start having those conversations with your insurance agent so they can start putting you in touch with the right people. It's not a last minute decision. It's something that takes a lot of time and energy to put into place.
So if these smaller contractors are going to be doing government work, they should seriously be thinking about this.
Yes,
Okay.
yes. That is for
That
sure.
is probably the case
Yes.
for many of them. Okay, we do have another question. Let's see. Will we need to go through this entire process every time we need a bond?
Very good question. So if you are only going to talk to your surety company once a year, once every 2 years when you need a bond, then it's going to be this long, exhaustive process. But if you keep your communication lines open with your surety, then the process, it's a much more simplified process and it's a quicker turnaround. But if you do not stay in contact with them, then they're going to have to say, okay, I need your last couple years of financial information, tax returns, and so it just draws the process out longer.
Okay, so they should be providing that information every year, continuously?
Oh, yes.
Okay,
yes. Mm-hmm.
Sure.
Yeah.
Okay, very good. We have one more question. As the owner, can't I just put money into the company at the year's end and then take it out after the year's end to improve my working capital and net worth numbers?
Nice try. You're not the first contractor to try that, and the surety folks are aware of that. Okay, that they don't like that. That shows that you're just trying to manipulate the numbers so that your December 31st financial statements, look good, have a strong net worth number, and then you turn around and you pull it out. They want to see consistency. They would rather see the company have the net worth that it has, and then your personal financial statements that you're providing showing that you have that cash in your personal account and that it's available to transfer into the company. But don't play with the books. Don't put money in 30, 45 days later, take the money out. They don't want to see that, okay? That looks like you're trying to, remember, integrity, character, those are key things the surety company wants with their contractors. And so, put the money in, leave it in there. Make sure that it's something that you can leave in for a couple years before you need to pull it out again.
Okay.
Yeah.
So one final question that came to my mind. If you're establishing this relationship with a bonding company, is it possible that the bonding company, let's say they don't immediately want to give you the bond, will they be able to identify like your defects where you might need to correct and work with you?
Absolutely, and that is one of the values of having a surety, having a bonding program and working with your surety. Because like I mentioned before in the business continuation plan, it is during this process that the surety is going through your organization, looking at your organizational documents, your operations. And this is what they do every day. They see a lot of information from a lot of contractors of various size, various specialties, and they can give you input. And they can say, my underwriter is not going to give you a bond today, but if you will improve these 3 areas right here, then I'm pretty confident I'll be able to get the underwriter to approve a bond for you in the amount of X dollars or in the X dollar range once you get these things in place. So it's a very good exercise for you to make sure that your organization is buttoned down and performing at optimum levels for you to be able to get bonded and stay in the industry for years to come.
Okay, very good. So a rejection right off the bat isn't necessarily permanent.
Exactly. And if you've never been bonded before, I would anticipate it's very likely you may get rejected for the very first bond that you need. But like you said, there's going to be a lot that you will learn from that process, and there's ways that you'll be able to improve so that way you can get the next bond that you request.
Okay, very good. I'm sure that makes the viewers feel a lot more confident.
Yes.
Getting bonded.
Yeah, don't take it as a red mark of, oh my gosh, we're doing something wrong, we're not able to get this bond.
Yeah.
Look at it as a learning experience and what changes can I put in place to improve my organization going forward.
Great. Yeah, good information. Yeah, thanks a lot.
You're welcome.
So that concludes our webcast. So this is the end of our October webcast, and the subject today was on bonding capacity. It's part of the Impact Monthly webcast series on growing a business. So please join us next month on Tuesday, November 10th at 1 p.m. to learn more about using Microsoft Project as an effective tool for field and office planning, scheduling, and project management. Our instructor will be Nancy Brister, an expert on Microsoft Office with Align Abilities in Phoenix, Arizona. Thank you for joining our webcast today.